Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, March 4th, 2024. Hope everyone having a wonderful weekend. So, as always, we'll start with our executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So, today's key macro event is: will a crucial week of macro and policy updates trigger a correction in stocks? So, the nuance there is the S&P 500 is up 16 of the past 18 weeks, a feat not seen since 1971, and has happened only four other times in history, including 1971, once in the mid 60s and twice in the late 50s. Will this week's deluge of key economic data derail the bullish momentum that we called for at the start of November? Highlights include Japan's Tokyo CPI, US JOLTS reports, and global and ISM services PMIs on Tuesday, Australia's GDP and Eurozone retail sales on Wednesday, China's trade report on Thursday, and Eurozone GDP and the US jobs report on Friday. In terms of market implications, this week also provides investors with a bevy of critical policy updates, including BOJ Governor Kazuo Ueda's interview, the start of China's 14th National People's Congress, and a dozen states holding Republican and Democratic primaries on Tuesday. UK Chancellor Jeremy Hunt unveils his annual budget. Powell testifies before the House, and the Fed drops its beige book on Wednesday. The ECB policy meeting, ECB President Christine Lagarde's presser, and Powell testified before the Senate, as well as President Biden's State of Union address all fall on Thursday, and New York Fed President John Williams has an interview on Friday. While we do not expect any of these major macro or policy updates to end the risk-on Goldilocks market regime, our positioning model indicates conditions are ripe for correction. So any one or combination of these catalysts could lead to a consolidation of risk assets in the week ahead, in the weeks ahead. So transitioning to my 42 macro dashboard here. As always, we'll start with the trading range signals from our friends over at Longbow, getting an overbought signal here in base metals there. So if you're long base metals, anything playing a catch-up trade in China, just be aware of that. Got a near overbought signal in the spot. Not quite. I take that back there. It's got a little bit more room to the upside to the top end of the range. Same thing. Actually, getting a little near overbought signal. Get an overbought signal here in the Nasdaq raging bull market. Don't short raging bull markets. All you do with overbought signals in a raging bull market is two things. If you're a high frequency trader, you're booking gains and looking to buy the asset back on a pullback. If you are a long only type investor or dollar cost average type of investor in a raging bull market where you see a security or asset overbought, then all you're doing is slowing down your dollar cost averaging so that you can speed up your dollar cost averaging when the security or asset is oversold. Never, ever, ever, ever short a bullish VAMS or bullish price momentum market. That's how you lose a lot of money in this business. Markets go up over time. Anyway, getting back to this, so Russell 2000s got a near overbought condition as well. 10-year nominal treasury yield that is oversold, so bonds overbought is the implication there. Same thing with the 10-year tip yield. All that range is very narrow, so maybe not signaling much at the current juncture. And then I think we had a signal here in Bitcoin. Yeah, Bitcoin, as I mentioned, I've been saying this for the past week or so. It's things been hodling the upper boundary of its probable ranges, which is why I continue to stress that you don't short things that are overbought in a raging bull market. All you're doing is using that overbought signal to either slow down your dollar cost averaging or to trim a little bit so that you can buy a little bit more when this thing pulls back if you are a higher frequency trader. If you're not a high frequency trader, ignore that part of the discussion and focus on the part of the discussion that corresponds to you as a dollar cost average type investor. So as always, we'll wrap it up with a question from our community here. The question reads, hi, in the latest around the horn, a mention of a growing probability of a cross asset correction was not mentioned, or it certainly was mentioned, and I mentioned it one, two, three times during the position model call out and the quantitative risk management summary. So I'll correct the client there. Is the client correct? So I'm going back to reading the question. Am I correct in thinking that the risks have not gone away but are still high? My understanding of the part on page 35 is that the inflation plus deflation line, purple, continues to head down. That this means the probability correction increases. So I'll unpack that in reverse order. CACRI, which is our cost asset correction risk indicator, which is the combined shares of the inflation and deflation regimes in our global macro risk matrix, which are the two risk off regimes in our global macro risk matrix. It's the combined probabilities of those regimes on a smooth basis. But it's so that as that continues to fall, what it's effectively saying is that we are building a system, we are building up a sort of complacency in asset markets. As that thing gets towards its lower boundaries, you're effectively saying asset markets are about as complacent as they have been historically. We think about Crackery as sort of a cross asset VIX. It's derived from the 42 volatility adjusted momentum signals in the global macro risk matrix. And so as that thing continues to probe its structural lows, that's telling you that there's a decent amount of complacency risk out there. Doesn't mean a correction has to happen the moment you noticed that there's a lot of complacency in the market. It doesn't have to happen the day the person sitting next to you notices there's a lot of complacency in the market. The complacency is a vulnerability. You need a trigger to take advantage of that vulnerability to cause a correction. And that's what we're calling out this week, which is there's a crap ton of major important macro and policy catalysts this week that could create the trigger required for that vulnerability to turn into a correction. So that's exactly what we're talking about today in the Late Off Morning Note, and it's what we talked about on Saturday in the Around the Horn. So definitely make time to review those materials if you want the deep dive analysis that actually gets us to those conclusions. And then obviously what to do about it in your portfolio, either vis-a-vis KISS or vis-a-vis our discretionary risk management overlay if you're not following KISS. And just one final thing on CACRI. The real risk when you're talking about CACRI is not only just identifying that there's a lot of complacency in the market, which our positioning model continues to signal as well. It's also trying to identify when is that complacency starting to change? When are things starting to become less complacent from a period of extreme complacency? And crossing that consensus complacency threshold in that CACRI chart has historically been on balance a risk harbinger of a risk off market regime. So not always a transition to a risk off market regime, but the probability there is much higher than a lot of other things that signal in our and anyone else's process for that matter. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, March 4th, 2024. Everyone have a great day out there. We'll catch you back here tomorrow. Cheers.